Poised for Exit is a show for business owners who want to achieve a successful exit based on their own terms. Your business exit will likely be the biggest financial transaction of your life, and for most, you'll have one shot at doing it right. The topics and guests we feature and the stories they share will provide valuable ideas and strategies to improve operations and grow enterprise value so you can achieve the best possible exit outcome. Now here's your host, award-winning certified exit planning advisor, Julie Keys.
Welcome, everyone, to Poised for Exit, the exit planning podcast show. Today's guest is a partner with a law firm whose many clients include business owners and high net worth individuals. He advises on all things estate planning and tax. And today, we're going to be talking with him about what the new year might hold and what's going to happen to the Tax Cuts and Jobs Act. We're also going to talk about some other related topics relevant to business owners. But first, let's hear from our show sponsors.
Right now, there's a record number of buyers looking for businesses, and many businesses are selling at a premium. To get a free, confidential business valuation so you'll know what your business might be worth, contact a broker at Sunbelt Business Advisors at 612-455-0880. We're Minnesota's largest seller of companies. Let us help you maximize your life's work. Call 612-455-0880 or visit sunbeltmidwest.com.
Are you looking to add enterprise value to your business through effective marketing? At Evolve Systems, we craft custom marketing strategies designed to achieve your goals. Our comprehensive approach covers everything from branding and digital awareness to advanced lead generation tools. Positioning a business to sell in today's M&A market is not only challenging, but can be difficult without the right marketing strategy. We capture your ideal audience with clear and effective brand messaging that drives more deal customers. Let's evolve your business together. Reach out to us at 651-628-4000 or visit evolve-systems.com to start the conversation today.
Selling your business may be the furthest thing from your mind, but that doesn't mean you should wait to plan. At TrustPoint, we understand the nuances that come with selling a business and are here to guide you. From unlocking tax efficiencies to minimizing risk, we'll develop the strategies to ensure you're prepared. So, when the time arrives, you'll be ready to enjoy the best years of your life. Learn more at TrustPointInc.com. That's TrustPointinc.com.
Hello, Poised for Exit listeners. We are here in the studio with Christopher Burns. Welcome back, Christopher.
Thanks for having me again.
Yeah, so nice to have you here. If you remember right, listeners, the last time we had Christopher in the studio, we were talking about something as dry as estate planning, and he manages to make it entertaining and informative at the same time. So today will be no exception, although we're going to take a little bit of a different twist and kind of approach it from here we are 3 weeks post-election, and what's going to happen to the Tax Cuts and Jobs Act, right?
Yeah.
So we're going to kind of take that angle a little bit today, sprinkle in some of your well-informed advice from all the years that you've practiced and business owners you've worked with. So the federal rate, let's start with that.
Sure. So the federal estate tax has been kind of a moving target.
Right.
So way back when we had a $5 million exemption, going back to 1998, we had a $600,000 exemption. And we've kind of had this changing target over time. Right now, as we sit here today, the federal estate tax exemption is $13,610,000. The IRS released on around November 1st. Next year's exemption is going to be $13,990,000. But what was scheduled to happen, and really what the current law is that the existing federal estate tax exemption will revert to what it was when President Biden was Vice President Biden, namely a $5 million exemption index for inflation. So we'd have about a $6.5 million exemption. So we'd decrease, and the tax rate on amounts over that exemption is significant. It's 40%. And we also
have a lot of money.
Yeah, we also have a Minnesota exemption as well. So now my crystal ball on all of these things is perfectly fuzzy. I can't predict what Congress and any president's going to do.
Yeah, that's okay. We'll take fuzzy.
So the belief is that President Trump and a Republican Congress will attempt to increase or stabilize the estate tax exemption so that it won't revert down to, $6 million or $6.5 million, but rather will continue the exemption at that $13,990,000 level indexed for inflation or some similar higher level on a going forward basis. Now, there's some difficulty with the budget and making that all work out from an economic standpoint. And there's something called the Byrd Rule and reconciliation and overcoming a filibuster potentially on that. But it's thought that that's a piece of legislation that they should be able to make happen as long as it's a focus. Now, at one time, the first time President Trump ran, he was going to seek to potentially repeal the estate tax. And we haven't really seen much about that from the administration, this election cycle. So the belief is that, a higher exemption will be something that will happen and that we'll have. Now, just for contrast purposes, I realize Vice President Harris didn't win the election, but she had supported a drastically different plan. So just for comparison and contrast
Yeah, it would be good to know the comparison, right?
So she had supported a $3.5 million federal exemption by supporting Senator Elizabeth Warren's estate plan, and amounts under that plan would be taxed at a rate as high as 65%. Now, that would affect, generally speaking, people with estates of in excess of $93 million, and people with over $1 billion could have an additional surtax. But again, that's not something we're likely to see. But I always like to tell clients that, what we have now and what we forecast for the next 4 years, these ideas keep coming back time and time again.
Yep.
And so it really makes it more critical to think about your estate plan now, plan for what we have now, and consider all of the tools that might be available.
Okay, so if I ink my plan now with the way things are now, right, then is that, I don't know, for lack of a better word, grandfathered in, like it can't change if it's inked?
Sure. No, that's a great question. I get that question all the time. Generally speaking, most people do an estate plan now that is revocable, modifiable, changeable at any time, as long as you have your wits and capacity about you. And so your plan works for as long as you're living. But that doesn't mean that you're grandfathered in for the current tax laws. Certain people choose to do certain types of irrevocable gifts to take advantage of the tax law as it exists now. And lawyers love their acronyms and things. So I'm going to throw just a couple at you and the audience just to share. But
Sure.
That would be something that would freeze in, current law in general. And some of those vehicles are referred to as spousal lifetime access trusts, or SLATs. Some people call them spousal limited access trusts because lawyers can never agree on acronyms. Grantor retained annuity trusts, and certain other irrevocable trusts, including things called crummy trusts and ILETs, irrevocable life insurance trusts.
Sure.
So lots of different tools that we consider. And, frankly, had the election result been different, we probably would be exercising these tools so quickly right now to plan for Vice President Harris had proposed that I probably wouldn't be able to be here today. But because of the election results and a moment of, a little bit of, everyone waiting for that crystal ball to clear up, you get the privilege of getting to hang out with me.
I know, right? You're not like working 16 hours a day.
No.
Only 12.
Something like
Yeah,
that.
right. No, I wondered about that, because when we scheduled you to be on the show, it was pre-election, and I knew that there was a chance that I'd have to find a substitute if things would have gone a different way. So I just want to clarify a couple things for the listeners who, I don't want to assume that they understand. When we talk about maximums, like your exemption max, that's a combined number.
No, that's an individual
number.
So a husband and wife each have that exemption amount.
Oh, I'm sorry. I thought it was combined. Well, I'm glad I asked you. So what's included in that? Because, right? We got real estate, you got life insurance.
Yeah.
Maybe you were getting to that already.
Real estate, life insurance, 401k, IRAs, all sorts of different assets. Anything that you have what the IRS calls an incidence in ownership in is included in your estate. So often people think that their house is exempt from creditors, therefore that can't be included in your estate. Well, no, it is. As long as you have incidence in ownership in your house. It also includes tangible personal property, personal goods and furnishings, things like that Monet that you have on your wall, all of those sorts of things get added in. And also a little bit of a misnomer, life insurance, if you own a life insurance policy, is generally included in your estate. And our insurance agent community does a great job talking about life insurance, but that's a nuance that people often think, well, if I only pay a few premiums, my beneficiaries get this $1 million. How great is that? Well, that is great. That is a wonderful aspect of that tool. But that $1 million is included in your estate to determine, in most instances, what your estate tax is going to be. One interesting thing, though, about the federal law that's not available to the listeners here in Minnesota is the federal exemption is actually, under current law at least, portable. So if you don't use the entirety of your federal estate tax exemption, your spouse can inherit your unused exemption, the deceased spouse unused exemption amount. Now you only get the benefit of your last deceased spouse. So if you remarry after your first person goes,
Right.
you have you have a different issue. But that's a nice way to get that combined effect. So effectively you can almost have something approaching a $28 million total federal estate tax exemption. But also, unfortunately, Minnesota's exemption isn't portable. It's a use it or lose it. And that's that, again, $3 million figure. Generally speaking, now Minnesota does have some specialty rules for farmers and certain closely held businesses that allow us to get to a $5 million exemption. But those rules are very narrowly construed, and you really have to work through those. So those would be rules, I would say, not to be advised by your lawyer that's doing a will on Monday and a divorce on Tuesday and a DWI on Wednesday.
Right. So when we talk about all assets, how does the value of a business factor into that?
Sure. I'm glad you asked and knew you would.
Mhm.
So typically, when someone dies that has an ownership interest in a business, we have to work with our appraiser community to come up with a value to determine what its value is for estate tax purposes, and that's the value that a willing buyer would pay a willing seller for that interest.
Okay. So not book value. Yeah. So, and that's a valuation methodology determined by the IRS, or who determines the valuation methodology?
Well, we start with an appraiser using his or her expertise in appraising businesses as to what the marketplace would provide. Again, that willing buyer, willing seller methodology. But an appraiser is also going to take into consideration that not everyone wants to work with everyone else. So there could be a marketability discount if a person owns a fractional interest in that business, or a minority interest discount. So often as we're advising clients on estate planning decisions, we're looking at their asset ownership and the structure and trying to help them come up with a way that might allow us, to work with the very narrowly defined IRS rules. And we often, talk with our friends at the appraisal firms as well, so that we can, truly maximize the wealth transfer that our business owner clients are able to do upon their death.
So if I'm a business owner and I'm coming to you for some estate planning advice, maybe my estate plan is really outdated. I don't have all the things that I need. I don't have a healthcare directive. I haven't established any trusts. Maybe all I have is a will.
Mm-hmm.
How are you documenting not just those pieces that go a part of the entire plan, but what about my business? How is that documented in my estate planning?
Sure. So what we really try to do is kind of have a team approach in that situation. And so, sometimes, Julia, it might be with someone like you and, the talks that they've been having on their succession plan. It might be with their financial advisors or insurance professionals, accountants, what have you. And we try to understand what the global picture is, and also the key people in their business. And it might be something where we have a buy-sell agreement in which a key person agrees to buy, the business in the event of death or disability of the
Sure.
owner. And I know you've had other speakers talk about that concept on your show in the past.
Mm-hmm.
And, really work with them to try to have that big picture of the estate plan. So many people just, are order takers when it comes to these things, but it's really best if you can get the entire team, to agree to a vision, to agree to a plan, and really implement their goal. Because often, other than their spouse and children, their true baby for a business owner is that business. And we want that to be a successful transition. Sometimes it even involves, meeting with some of the key people. Usually not so much for me, obviously for people like you, but, sometimes people, want to ask that question. And also sometimes they choose to want to name those people as their fiduciaries.
Yeah.
And I often challenge clients and say, your co-business owner has to, take over and do everything that you do. And I often strongly encourage them to see if they can't find someone else to be that trustee, to be that personal representative.
Yeah.
Personal representative, the term that people often think of as executor, and have that person in place, to be able to administer things. And sometimes it's also some short-term, type thinking,
Mm-hmm.
and the whole transition process that you deal with on a daily basis of making sure that they have someone that can, they die and on day one, turn on the lights and
Right.
keep things going and keep clients and customers satisfied and not panicking.
Right. Yeah. And just so that people know what their wishes are. And like you said, to have a plan to keep the lights on, because continuity is everything, especially if there are survivors that have interest or, stakeholders, right?
Agreed.
When it comes to powers of attorney, should they be separate for the business versus personal?
It's the classic lawyer answer of it depends, but almost always yes.
Sure. I figured that. I just wanted to ask.
No.
Yeah.
And the other thing that I like to tell clients to do is, look and see who has the key ability to sign checks and do things, because that's kind of a day one type of thing. And a lot of my self-starter clients that have, started the business and made the business what it is, they're the only ones that can sign things and can do certain things. And I encourage those clients strongly to have, someone else to back them up. And I also encourage them that maybe if they're on vacation, someone else can sign payroll, someone else can do some of those things.
Oh, yeah.
And so often people are rushing back for payroll because they're the only signers. And I always encourage, and I fail miserably at
Same.
letting go, but I
Yeah.
always encourage clients to try to do what I don't do.
Well, I think, just that particular point, I bring that up often too with my clients is, if you have a signer on the account, that doesn't mean that they have all the rights to the account. Doesn't mean that they can move money around or lend or borrow or whatever, right? Just as they could be a signer, right? So that you're not stuck in those situations. Or you end up, God forbid, you end up in the hospital.
Agreed, 100%.
Yeah.
And with the hospital too, like you said earlier, they really have to make sure that healthcare directive is in place. I had a doctor client in the other day, and it was the cobbler with no shoes, a 50-something-year-old doctor. He had never signed a healthcare directive. His wife is a nurse. She had never had a healthcare directive. They
My
talk to
goodness.
people about them all the time.
All the time.
And it was, cobbler, who has the kids with no shoes type
Yeah.
thing. And they both felt very sheepish about that. But they have one in place now. And, that provides them some comfort.
That's good. So looking ahead, so what does your crystal ball tell us our tax rate might be in 2025, federal? We already know Minnesota's not moving, but
Yeah, I think the federal will probably be that 13,990,000 with a 40%
Okay.
tax rate. I think 2026
yeah,
is really more the question mark, and
yeah.
I'm
Because
optimistic.
this is till the end of December anyway next year. We got a year left, but
Yep.
yeah, right.
But I am optimistic that we'll get to, one of two different variables. I
Right.
think we'll either continue with the law without the repeal, without the reversion, and it will just continue indexing for inflation. So it'd be 14.2, 14.5, something like that, 40% top tax rate, and then thereafter index for inflation. Or alternatively, maybe they just pick a flat figure, and unlike many provisions of the code, they just don't index it for inflation. They just say $15 million per person or something. I could see either of those having some traction. I don't really foresee repeal so much. I think it's too expensive to get through the budget cycle. And so I don't see that having traction as much as it used to, but certainly could see an outside chance of repeal happening, at least for 4 years. Usually when repeal happens, they try to address that with almost a Canadian type tax system where you don't get that step up on basis anymore. And while that gets convoluted and complicated, the simple example is this. Think of a share of stock that you bought a long time ago and you bought it for $1 and it's now worth $100. When you die, your beneficiaries get that with a basis of $100. And that's how the current law works. If they get rid of that step up in basis when your next generation, when your heirs receive that, same example, bought the stock for $1, it's worth $100. Your heirs would have to pay a capital gains tax on that $99 in gain. And that's what, a lot of people have favored and people have looked to, Canada and some other places that have implemented that. And it's just really hard to track. It hasn't worked. We briefly had that in the 1970s. We had that in 2010 for a blink of an eye. And, I could see that in a future generation, a future leadership, future president. But that's something that I think is completely out the window for this next 4-year period.
Yeah, I mean, if you're an heir and you inherited an asset and you can't afford to pay the tax, you probably got to sell the asset to pay the tax.
That's exactly the case. And
Doesn't help anybody then, except for the government.
Correct. Well,
Yeah.
and think of our farm clients, our closely held
I
business
know.
clients.
I was just
all of
thinking about
those,
that. Yeah,
and how
real estate.
and how that could just devastate so many employees.
Oh yeah,
I forget the statistic of how many employees are employed by small businesses, but the numbers, LLCs and closely held businesses is just enormous. And speaking of LLCs, while you've covered this before, it's important to know that with that December 31st deadline, that Corporate Transparency Act, those rules are still upon us, and
Yes.
all of our clients in the listening audience and all of our friends in the listening audience, really need to make sure that they're tending to that Corporate Transparency Act, for all of their LLCs and other reporting entities with the Secretary of State, and that's really far-reaching.
It is far-reaching, and I think that it's just not talked about enough in social circles and public circles. I think there's a lot of owners that are still not aware of it, and the penalties are steep. And so thanks for bringing that up, because that is a good reminder. I did have someone else on the show recently who talked about it. We got our filings done at our house, and I've been bringing it up with my clients too in planning sessions, like make sure you get your CTA done, and I think that when we utilize services of an accounting firm to do our taxes every year because we don't want to mess with it, we probably look at that like, oh, it's going to be a pain. I'm not going to understand it. I'll probably do it wrong. And so therefore we shove it under the rug until we, flaming inferno, and you have to get it done. Do you think, though, that maybe you don't know, but I was just thinking if everyone waits until the third week of December to get that done, could it clog the system? And,
No,
I'm just a little worried about that. Don't wait too long,
Yeah, we've been telling clients that time is really of the essence, and you really need to get that done. And we've been encouraging clients to try to get it done the first week of December. And we just recently did an email blast for our clients, suggesting just that.
That's good. Yeah. For all the accounting firms out there and law firms out there, please take that example if you haven't already, and email all of your clients who are business owners and let them know that they need to get this done. So appreciate that. All right. Smaller companies. One more question for you. I think that there's a misnomer with a smaller business. They think that, well, I don't really have anything. I got the business and I got, my house and maybe a couple $100,000, whatever they have for assets. And maybe they don't think that they really need to plan. Let's talk about that for a second.
Sure. And in my mind, there's no estate that's, genuinely too small to plan for. And, the closely held businesses, the businesses that have 1, 2, 3 employees, think of how those employees depend on you and depend on the work that they have. And so, for even the small businesses, there's a great opportunity to do planning. And the other thing is, I think the perception is most people think their business is worth more than it is.
Sure.
But I've certainly seen the case with small businesses where the client, gets that blue sky offer that they said, well, my business isn't worth that. This person's crazy. And they've pleasantly been surprised when they've chosen to go to market. And maybe they're basing it on old metrics, on EBITDA or earnings or other things. And the marketplace has changed, and it continues to evolve and change. So
it certainly does.
It's good to have a check-in on that too. And I've encouraged some clients to talk to an appraiser, talk to a business valuation firm as a part of the estate planning practice.
Yes.
And often those, experts have, really opened their eyes a bit. And sometimes it's not necessarily the actual day-to-day owner, but it's their spouse that never really recognized that, this thing that the husband had on the side or something was worth that much. And I had a client that was an artist that had a lot of stuff in inventory, and his wife didn't think it would be worth that much, and it was really worth a great deal. She knew how much individual things had sold for, but had no concept what the inventory might be worth. And, there's lots of legions of examples of underappreciating the value that people have and the growth in real estate.
Right.
Few of my own quite a bit of real estate. They only use a little bit, and they kind of forget about the back 40.
They do. They forget what they have.
And with development all around them, it could be the next office park or, next who knows what. So
for sure,
a lot of opportunity out there. I think lastly, with a small business owner client, there's a great opportunity to feed them back to you and to others to really succeed at that succession and make sure that they're, getting that next generation person, that next key person that can keep it going, especially with these niche services.
Yeah. There are a lot of businesses out there that could become transferable if they just put a little effort into it. And so many of the time, that transferability is part of the nest egg and necessary. And so it's just, continually spreading awareness and talking about it and how important it is for owners. Well, Christopher, thank you so much once again for being on the show, sharing your wisdom.
My pleasure.
Really super appreciate it. And thank you to all of you listeners out there who support us and rank our show, please do share this episode. Join us again next time. And Christopher, we will have contact information for you in the show notes so that people can reach you. I'm sure you guys have got some really valuable resources on your website that people can download and, right, question checklist, email you, whatever, right?
We do. And encourage people to look at some of the estate planning articles, because that's often an easy way to bring up these sorts of questions to others, to loved ones.
Perfect. We'll make sure and link those. All right. Thanks so much.
Fantastic. Thank you.
All right. Thanks, everybody.